Have you ever noticed that the biggest fortunes in investing were rarely built by people who simply followed the crowd? It almost sounds backwards. We're taught that there's safety in numbers, yet in the stock market, the crowd is often late to both the party and the exit. That's one of the most fascinating truths in investment psychology, and it's exactly why the best investors think independently. Think about it for a moment. If everyone believes the same thing, acts the same way, and buys the same investments at the same time, where's the opportunity? Legendary investors understand that extraordinary returns often come from seeing what others overlook, not from agreeing with the majority. The challenge is that independent thinking isn't natural. Human beings are wired to seek approval. When everyone around us is excited about a soaring stock, it feels uncomfortable to stay on the sidelines. And when markets fall, selling feels safer than holding. That's herd mentality at work. It's driven by fear of missing out, social proof, and the emotional need to belong. Warren Buffett once said to be fearful when others are greedy and greedy when others are fearful. It's a simple sentence, but living by it is incredibly difficult. When headlines scream that the market is crashing, logic is usually drowned out by emotion. Yet history has shown time and again that panic creates opportunities for patient investors. Charlie Munger often reminded investors that having the right temperament matters more than having a high IQ. The market doesn't reward intelligence alone, it rewards discipline. Independent thinkers don't ask, what is everyone buying? They ask, what is this business actually worth? That small shift in perspective changes everything. Consider the technology bubble of the late 1990s. Investors rushed into internet stocks because everyone else was doing it. Valuations stopped making sense, but questioning the crowd wasn't popular. When the bubble burst, fortunes disappeared almost overnight. Those who stayed grounded in fundamentals were far better prepared to weather the storm. Independent thinking doesn't mean disagreeing with everyone just to be different. It means forming your own conclusions based on evidence, patience, and careful analysis. Sometimes you'll agree with the crowd, other times you won't. The difference is that your decisions are driven by conviction rather than emotion. One of the biggest investing mistakes is believing that action always leads to better results. Legendary investors know that sometimes the smartest move is doing nothing. Patience isn't passive. It's an active decision to let time work in your favor while others chase the next hot trend. Howard Marks frequently emphasizes that successful investing isn't about being right with the crowd. It's about being right when the crowd is wrong. That requires emotional control, humility, and the willingness to look foolish in the short term if your long-term reasoning remains sound. The truth is, every investor faces moments of doubt. You'll wonder if you're missing out. You'll question your strategy when others seem to be getting rich faster. Those feelings are completely normal. What separates exceptional investors isn't the absence of fear. It's the ability to think clearly despite it. The next time you feel tempted to follow the crowd, pause and ask yourself a simple question. Am I making this decision because I've done the work or because everyone else is doing it? That single question could save you from costly mistakes and help you build a stronger investor mindset over time. The market will always have noise, hype, and fear, but independent thinking remains one of the few lasting advantages available to every investor willing to develop it. If you found this perspective valuable, consider subscribing and sharing it with someone who's working to become not just a better investor, but a better thinker.